Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today is Thursday, so we are looking at the 18th episode of the Market Pulse series. So feel welcome, and if you have any questions related to the presentation, just type that in the live chat section, and I'll be responding to that right away. So once you join in, kindly type hi on the live comment section, and this will confirm that everything is working just fine. Awesome. So let's get this started right away. Let's start with the economic calendar. We had some big surprises happening in the economic calendar earlier today. So I want us to focus on those first before we cover anything else. So I will be using a very popular economic calendar here. And this is the Forex Factory website. All right. So it has been quite a busy day. I think my internet is a little bit slow, so I'm going to chill for a moment. All right. So today being Thursday, we have had quite a number of data announcements. One of them is the jobs data in Australia, indicating that the job market is contracting. So instead of creating jobs in January, we saw the net job creation going to a negative, meaning that more people are losing jobs. So employment change was down 11.5K in January, that is in Australia. And also the unemployment rate started to spike from 3.5% to 3.7%. So for those who have been following Australia closely, you also know that the inflation has been on the rise. So all economic conditions are pointing to the negative side, which might prompt the Reserve Bank of Australia to get more aggressive with the rate hikes in order to address the inflation problem. So besides these, we had the most important news for the day, and this is the core PPI, or Producer Price Index for the US. So it had a big spike. Notice that in the previous month, that is December, it was 0.3%. Then in this January month, it was up 0.5%. So similar case happened to PPI. In this case, it's been food and energy prices. So in December, it was a contraction. It was deflationary at negative 0.2%. But January, there was a big spike to 0.7%. So what this basically means is that the data focuses on the change in the price of finished goods and services sold by producers. So when you see it spiking from negative 0.2 to positive 0.7%, this basically implies that the producers are getting goods and services at much higher prices. And now, when these prices are pushed on to consumers, then the following consumer price index is expected to be higher. So it's almost like an early indicator to the expected inflation in the US economy. So you can see in the previous reading, the lower side, then this month very spike to the positive side. This is very inflationary, basically indicative that inflation is taking hold in the US economy, and the Fed might be forced to go for a stronger rate hike. So when the Fed is making a decision, it looks at a cocktail or at a mix of different data points that indicate the health of the US economy. So one of the things that we have seen is that the inflation did not slow down as much as expected. This data was released on Tuesday. So on Tuesday, we saw CPI dropping to 6.4% from the previous 6.5%. So if you look at the movement for the last 6 months, you notice that every month we have seen inflation drop further, but this one is almost flat. So it wasn't a big surprise in the market. Just like the other month, you can see it's a big drop, a big drop. But now, if you compare 6.4 and 6.5, it's almost the same, meaning that we could be seeing this curve changing direction and starting to move up. And this is something that a lot of investors are currently worried about in the markets. So besides the CPI, we also watched the retail sales data on Wednesday, that is yesterday. So retail sales came in very hot. Retail sales was up 3.0% on January, compared to a slowing year. So what this means is that the American consumer is seemingly very strong and is willing to purchase even more goods. which basically creates a higher demand for goods and services in the retail sector in the US. And this has the effect of increasing prices or basically increasing inflation. So one data point here, retail sales are indicating a very strong US economy. Manufacturing in the Empire State Index, in this case, it was a negative 5.8. But then if you compare with the December figures, then you see that manufacturing was on a big slowdown in December. So this is still a contraction, but much smaller compared to what we were expecting in the previous month. So it basically indicates that the manufacturing conditions in the Empire State are improving. I believe Empire State refers to New York in this case. So now moving on, we also saw some other data happening earlier today. And this was manufacturing from Philadelphia. So this is the Philly Fed Manufacturing Index. So previously it was down 8.9. So we expected an improvement to around negative 7.6. So this was a mixed reaction. In this case, it basically shows that manufacturing conditions in Philadelphia are worsening. Then the labor market continues to be tight. Unemployment claims refers to the number of people who are filing for unemployment insurance for the first time. So in the previous reading, it was 195,000 people. So we expected this to increase to 200, but it was a smaller number at 194K, meaning that the economy is very strong. It's not quite getting to the expected results of 200K jobs. So there's less and less people filing for unemployment insurance, indicating a very tight labor market. So with this in mind, when you combine other data that we have seen in the US, building permits previously was 1.34M. We expected this to increase to 1.35, but remains the same. So this is an overall neutral data point. And then housing starts. So previous reading 1.37 million. We expected this to drop to 1.35, but in actual sense, it dropped to 1.31. So this is indicative of a slight slowdown in the housing market, where there is less people are starting new houses. At the same time, the number of new building permits issued was relatively the same in January compared to December. So these are indicating a slowing pace in housing. So remember, the overall trend that we have been seeing in housing has been the housing market cooling off. Now the speed is slowing down, basically meaning that at some point we could be seeing housing sector starting to get hot again. So we are seeing conditions that are not very much desired by the US Fed. So remember, for the US Fed to cut or to stop hiking interest rates, then they'll be looking for a couple of data points to happen in the US. So one of the data points they are looking, which is the most important, is inflation data. They want to see inflation dropping towards 2%. So that's the major focus. So other indicators that show that inflation could be going down are one, retail sales getting slower. So if people are buying less stuff, our demand is generally getting slower, then in that case, we expect inflation to go down. So that is not the case, and that's quite concerning. So in the job data, which happened 2 weeks ago, we'll try to peruse this one quickly. So it was on Friday. This was the 2nd of February. We saw the US create a very large number of jobs, about 517K jobs. So if the US economy is creating even more jobs, it means that more people have a high income, or basically more people are on gainful employment. And these results with more people having more money to spend, which creates a higher demand or higher amount of money and running, competing for a smaller number of goods, which eventually creates inflation. So for inflation to be going down, they expect unemployment to be rising. However, from what we are seeing in the data, the US is at a record level, and this is a multi-year level of unemployment rate, which is 4%, the best that we have ever seen. So at the same time, if you look at the non-farm employment job change, a very large number of jobs were created. And also, the average hourly earnings are still increasing. So in the previous month, that is December, they were rising by 0.4%. So there is a slight slowdown to 0.3%, but this is not the desired effect. The US is looking at earnings, the average hourly earnings gets slower and smaller rather than keep increasing. So as you can see, this continued rise in average hourly earnings is adding more pressure to the inflation situation. And now, considering all the data points that we have discussed tonight, then you know that the Fed will be forced to get more aggressive or more hawkish with the rate hikes. And you can see the reaction already happening in the markets. So trying to make sure captured all the US data. So we had the CPI on Tuesday. On Wednesday, core retail sales, Empire State Manufacturing Index. Industrial production month over month. Previously, it was a contraction of negative 1.0%. This was in December. But then in January, there was an improvement. So in this case, no contraction, but 0.0%, which is basically an indication of improving industrial manufacturing conditions. And this is quite good for the economy. So on the other hand, business inventories, this is the stock held by businesses, was previously 0.3%, maintained the same level. Housing market index was previously 35 and now increased to 42, which basically indicates an improvement in housing. So when now you shift to today's data, and this is the producer price index as well as building permits and housing starts, then there's a very strong case that the Fed will be forced to get more aggressive with the rate hikes. So the current talk from the Fed members has always been the same for the last couple of months. They're saying that they're looking to hike interest rates higher and then keep them high for longer. So the interpretation of this is that if interest rates are high, then there is a lot of companies in the US that operate on debt, and they'll have to pay more of their revenues towards debt repayment since interest rates are higher. So they will be paying more to their debts, and they will be left with less money to expand their businesses and also to pay their investors through dividends. So companies are expected to take a hit from high interest rates. So if they're looking to borrow to expand their businesses, then they'll be borrowing at much higher interest rates, and these basically slow down their expansion. So at a personal level, we know that there's a lot of Americans with a very high credit card debt. So with interest rates rising, then the credit card debt is also rising. So this means that the employees or the workers in the US will be spending more money towards repaying their credit card debt, and they will be left with less money to spend within the economy. So the ideal situation for Jerome Powell would have been pretty simple. Unemployment rising, housing slowing down, aggregate demand going down as a result of high interest rates, and these would result in much slower inflation. So this is not currently happening. We have seen the economic conditions defy what the Fed wants to achieve, and as a result of this, then the Fed might be forced to get even more aggressive, and this would, in effect, strengthen the US dollar, whereas it would weaken equities. So with that expectation in mind, if you look at the charts, I would like to start with the dollar index. You can see since the CPI data on Tuesday, the dollar index started strengthening. On Wednesday, continued growth broke out of this range. So notice the range had held for like 2 weeks. Then today, after this pullback, we attempted to push even higher before the pullback in the last 2 hours. So this is indicative of a strengthening dollar. So even from before our chart, you can see for the last 3 weeks, it's basically the dollar recovering. And now that we know that the dollar is strong, if you look at other markets, I will start with the US equities. That is the major indices. Then you notice that they're also making a very strong recovery. So starting with the S&P 500, you can see, sorry, not recovery, but weakening. So all these indices from a daily chart, they had broken the upper trend line. So remember, this is the price action of last year from this high and closing around this area here. So from this chart, we can identify that the market opened here for the year, kept going down, and now for the past 2 months, that is January, attempt to rally, but then the overall trend is still bearish. So investors have been looking for weakness in this rally so that they can continue shorting, but the weakness has not been present as a result of optimism that the Fed go for a slower rate hike. In fact, in the previous meeting, that was early this month, when the Fed met and decided to hike interest rates by 25 basis points, it was largely taken as a dovish, So we were expecting that the Fed would slow down, but from what we are seeing from the economic data, there is a good chance that the Fed is no longer slowing down, and it has more pressure to keep hiking interest rates with stronger numbers, perhaps even 50 basis points on the book. So you can see the price action here on Tuesday, Wednesday. Today attempted to go up, pull back down, and now in the last 1 hour, we are seeing some more pullback. However, my overall expectation is that this price continues pushing down. So we will potentially be seeing the S&P 500 going all the way down. So similar case, we had this bullish channel happening in the US 30 or the Dow Jones. So after Tuesday, the market dropped, made a recovery, another drop yesterday, recovery, and then today, some further drop with a slight break of the lower trend line. And now potentially, we are seeing the market forming lower highs as well as potentially lower lows. So we could be seeing, as we proceed towards the end of the week, the indices printing even lower numbers. So same case is happening with the US Tech 100 or the NASDAQ 100. So we have this bearish channel on the 1 hour chart. So we were expecting some price action on Tuesday during the CPI news. So there was a lot of whipsaws yesterday, broke to the upper side. They went all the way back down, bounced here, but then my overall expectation is that the dollar continues strengthening and these indices continue to weaken. So as we proceed, you should know that this is not investment advice. So this is purely educational to help you understand these key concepts and also the key price levels. So as for Brent, you can see it's printing some good patterns here after ranging this particular channel here. Broke towards the upper side. This was yesterday, pulled back to retest and then moved even higher. Then earlier in the London session, dropped before attempting to recover in the New York session. So from what we are seeing here today, it was the market retesting this area a couple of times. And now, the most interesting point here is that the market is forming longer, lower tails, indicating a rejection of lower prices. So potentially indicating that buyers are making a very strong entry. And we could see the price continue to rally and get to last week's high. And this is a price level of around, just checking here, $86.639 per barrel. So as for the FTSE, very nice rejection here. So we can already see the star candlestick here. So from this strong rejection towards the upper side, you can see the long tail indicating the rejection. So after these, we saw the price continue to push further downwards. But in the last 2 hours, we have seen a lot of reversals happening across board. So remember, last 2 hours is what we are seeing here. A market reversing in US Tech, US 30 last 2 hours, and also US 500 last 2 hours. However, the overall thesis continues. So remember, the markets don't always move in a straight line. So even if we have this pullback and retest of this area, my overall thesis is that the market will continue to pull back down, being this overbought extreme price level. So at some point, I will be expecting this market to start pushing further downwards. So for USD against the Chinese yuan, we are seeing a break that happened here. And as the dollar index continues strengthening, the market broke this resistance and has continued to push even higher. So any form of pullback could be taken as a potential entry point for a continued bullish position. So Hong Kong are still bearish, erasing some of the gains we had seen in the earlier parts of the year. We can see what looks like a head and shoulder. This being the first shoulder, the head, the second shoulder, the line here being the neckline, and then the breakout happening here yesterday. So after this breakout, market went back to the pattern, and now it's retesting the same area again, but the theme is the same. Market is consistently forming lower highs and also lower lows. So I expect a breakout further downwards for the Hang Seng Index. So EU 50 also forming a very similar pattern with the FTSE 100. So stocks seems to be very hot in Europe, but the fundamentals are not following the same path. So at some point, once the central banks, that is the ECB and the Bank of England, get very aggressive with the rate hikes, then we'll be expecting these equities to move further back downwards towards the lower trend line. So USD against the Swiss franc, currently breaking towards the upper side. indicating the strength of the dollar. So notice that it was a long-term bearish momentum in the forward chart. This is extending all the way back from November. And now what you are seeing here is a market that is beginning to form higher lows. So if you look at the previous low that we saw here, then this low here, then the lows are getting higher and attempts to break are already appearing in this chart. So potentially we're looking at the market breaking and changing the trend. So from the 1 hour chart, you can see the first break yesterday, today forming the second break. So eventually we'll be expecting to see even a higher price action from these. So also if you look at the highs, there's a slight angle here indicating that the highs are getting higher. So potentially we'll be seeing a reversal with the dollar regaining its strength. So silver and gold have both erased the gains that had happened from the beginning of the year. So now trading towards the negative territory. So for gold, just to give you a highlight, from the 4 hour chart, gold opened here. This was the price at the beginning of the year. So spike the first week, pulled back down to retrace the area and then rallied on the second, third, and fourth week. Then come February, market pulled back down, broke the lower trend line, went all the way up, then sharply fell all the way down. Then the second week traded sideways on this channel, or what we call a flag. So we had this flag trading here and then a break, another flag here and then a break. So all these eventually erased the gains that we had seen at the beginning of the year. So this is indicative of a change in the market direction, where on one side we had the new year starting off very well with people afraid to invest in stocks. Out of profit taking was happening, and the dollar was weak. Sorry, not that way, the other way around. So people very confident about stocks. Remember, January was when we had a very good performance in stocks. Some of them going 20, 30% in the S&P 500. So we saw this strong rally happening in gold, as well as Bitcoin and other assets. But then once we go to this area in February, we are seeing the exact opposite, the equity starting to weaken, gold weakening, and also the US dollar starting to strengthen. However, the opening price of the year seems to be a psychological price point. So for those people who have been shorting for the entire month, it seems like the price of gold is making a very strong bounce. So from the last 2 hours price action, it indicates there's a very strong bounce from this area, and potentially we'll be seeing the price of gold now begin to rally from this bottom and perhaps retest the previous resistance level. So we have some short-term targets. You could look at last week's lows. This area here would be an area of concern. And if it's broken, then we might also be looking at these other areas here along these highs here. So you can see there's an area here where the market was majorly finding resistance. And this is an area around 1865, 1866 here. So 1867 might be a target if gold happens to break this area here. And if you look at the forward chart, then it seems even more realistic that gold could continue rallying, get to this previous high here. So as we proceed, if you have any questions related to the presentation, feel free to type those questions and I'll be responding right away. So what's driving the market, especially stock, with the high inflation rates and the risk of subsequent hikings? So there has been a period of time since the beginning of the year where we have seen a lot of confidence and a lot of investors going to risk on mode as a lot of stocks were recovering. But the data that is flowing from the US economy is indicating strength and resilience, which is good for stocks. But then remember, the markets are forward-looking. So with jobs at all-time low, that is unemployment at all-time low, industrial production expanding, retail sales rising higher, means that the consumer is strong. There is still sufficient money in the economy to drive growth, and this is positive for equities. However, when you look at the Fed and what the Fed is looking to do, in order to achieve the 2% inflation target, then the Fed will have to hurt the economy by raising interest rates higher. And once they do that, then as a result, we'll be seeing weaker equities and a stronger dollar. So to answer your question, yes, the economy seems strong and stocks are doing well. The earnings are also doing pretty well. But then going forward or thinking in terms of the market expectation for the next 1 month or 2 months, then we will be expecting a stronger rate hike, and this is expected to eventually weaken equities. So whereas we are seeing a strong bull run, should be an indication that there is a potential good entry points for short selling positions. So I hope I've answered your question. Follow. So please answer on FTSE 100, which is on steroids, in an economy expected to get in recession according to IMF and Bank of England. Yes, it's the same thing that I'm seeing. So with Bank of England, slightly avoided getting into an official recession in December when they printed a slight growth in GDP of 0.1%. So now, as we proceed with this year, we are seeing a lot of news indicating that the UK economy is resilient, but then inflation is still very persistent. So from the data that we saw, I think this was on Monday, inflation in the UK was 10.1%. Actually, this was yesterday. So an inflation rate of 10.1% is so much higher compared to the target of 2%, and the Bank of England will have to get very aggressive. So last week, we saw the Bank of England was going for a 50 basis point hike, and going forward, we'll be expecting something similar. So with the FTSE 100 being on steroids and rising even higher, then I think it's a market that we should be considering as ripe for going for short selling positions. So it's all about monitoring the price action and looking for potential entry points, especially when the bull run starts showing some form of weakness. So Bitcoin, yes, we'll be checking on that. USD is really misbehaving. I'm struggling to understand, is it bearish or bullish? Any help? So as we have discussed today, I think the US dollar is going to be a little bit more bullish than everyone is expecting in the markets. So once people start realizing that the Fed will have to keep hiking rates and keep them higher for longer, then they'll continue buying the dollar. And in that case, we'll be getting some good positions in the indices. So we have already covered gold. Euro yen, I haven't checked that. So we have already checked on the NASDAQ. Let's see, I'm mentioning 1 hour time frame. So by Bitcoin, NASDAQ, we'll check on that. So after the release of CPI data, the markets didn't move much. It was better at 6.4% as compared to 6.2%. However, 6.4% was lower compared to the previous month at 6.5%. Yes, it was a mixed reaction. That is why we had a whipsaw. So we expected inflation to drop significantly to 6.2%. And in this case, we would be expecting Jerome Powell to go for another 25 basis point hike, get interest rates to 5%, then keep them around there flat for a while while observing the economy. However, what we saw is inflation dropping slightly, 6.4%, but then this drop was not significant enough. It was indicative of inflation getting sticky within the US economy, and this is something that investors are worried about. So if inflation gets sticky, then the Fed might have to hurt the economy more by hiking interest rates even higher. So that's one of the reasons we had this mixed reaction. And now that we are getting more and more data that the Fed will be using in making the next decision, all this data is supporting the Fed members to vote for a stronger rate hike. So that's why we are seeing the dollar starting to strengthen, especially on Wednesday and now today, Thursday. So does this mean indecision in the market since the actuals are better than forecast, whereas the actuals were worse than previous month? Of course, there was indecision on Tuesday, but if you look at the price action after that, it's basically indicating more confidence that the dollar will strengthen and less confidence that the bull market rally in equities will continue. So your view on PPI data, I think you already mentioned that at the beginning of the session, that the PPI data is indicating inflationary pressure. So by the next reading of the CPI, we will be expecting US prices to be much higher, and as a result, we'll be expecting higher inflation. So going forward, let's look at, there was a question about gold. Just trying to check. So I mentioned that these are very strong bounce. This is the price that we had at the beginning of the year. So we have already hit today's high, and also this was Tuesday's low. So potentially, if you break this level, then we'll be looking at the price of gold moving all the way up to an area around 1867. So still checking on the questions you guys raised. I think much of it is a repetition, some of the stuff that we've already covered. I think I saw a comment about Euro JPY. So I'll try and check on that. So remember, the new Bank of Japan chairman was nominated by the president, by the prime minister, and now he's waiting approval from parliament. So as we all know, when it comes to technical analysis, it's always easier to start with a higher time frame and then get a perspective as you focus on the smaller time frames. So for instance, all the way from 2021, it seems that the euro has been gaining against the Japanese yen. So if I was to look at the swings here and then this swing, then extend this, then I would have this expectation that the market was following this particular trend up until it broke towards the lower side. So from these, we also have an understanding that in the previous couple of months, and this is from October last year, the market has not been able to break this resistance here. So those are some of the key ideas that we can easily identify here. And now, if you move to an even smaller time frame, then we can see that there is a key price level here that the market seems to be playing around. So every time the market has gotten to this level since December, has found resistance and went back downwards. But now, in the most recent price action, seems like the price has broken this level and is now headed higher. So on the lower side, it's not horizontal, seems to be some form of trend line. So if you zoom out, it seems like the market is following a path along this area. So for the last couple of weeks, there has been a lot of swings, up, down, up, down. So not very trendy. We know that trending markets tend to establish very nice trends. So after all this noise, up, down, up, down, up, down, this was a major resistance level. Now it has been broken. So we know that once a resistance level has been broken, it's quite common for the market to retest before continuing in that direction. So we might see the market retesting this area. And once it gets to retest this area, we'll be seeing the buyers come in, then pump the prices even higher. So the idea is to look for a bullish position around this area. That is when the market goes back down, and then you see indications of buyers entering this market. So if this doesn't happen and the market keeps going down, then you trade it downwards. So the idea is to observe the price action around this area. So I'm hoping that that makes sense for everyone. So US30 seems to be flying upwards. So US30 was the most resilient index last year as a result of being dominated by industrial stocks. So you might see that whenever there is a high inflation, industrials tend to be quite resilient compared to the other indices. So the tech sector was the weakest, the biggest loser last year. And now you can see it's the same thing happening in US 500, US 30, but then also the same thing in checking on the data, the news happening in the markets, try and get a perspective on this. So let's try and get some of the insights here. So from the economic calendar, this is what we're expecting for the remaining part of the week. So for US, we don't have any news. I expect a speech from FOMC member Bauman. This is 4:45 p.m. tomorrow. CBA leading index month of month, and also mortgage delinquencies. And this is tentative. So I don't expect much to be happening around this area here. So I expect a lot of technicals to be dominating the markets going towards the end of the week. So that being mentioned, let's look at the S&P 500 map. So clearly, the S&P 500 has been weak. This is the top 500 companies in the US, and a majority of them has been losing since the open of the market today. So if you change this to weekly, 1 week performance, then you notice that a majority of them has been in the green, meaning that we are seeing a shift in the trend. So in the short run, the S&P 500 is on the weaker side, but for the last 1 week has been quite positive. So if we now change this, the year-to-date performance, that is the performance is the beginning of the year, then you can see a majority of the strength was on the stocks that were largely being sold last year. So some of the outperforming stocks include NVIDIA, which is up 52%. Apple is up 19, Microsoft is up 10, Disney at 23. We are seeing Tesla making an impressive comeback, rising 74%. Also, we are seeing stocks such as American Express up 21%, MasterCard 7%, Visa, and so on. So clearly, the stock started on a very strong foot. And this was based on the expectation that the Fed will slow down to 25 basis points and then eventually slow down to 0 and keep rates there. But now the economic data coming from the US is indicating a totally different tone, and this bull run be wiped out as easily as we got it in January, mainly as a result of a stronger rate hike. So you have to consider all the data points that the Fed is also looking at in order to make a decision about the US economy. So as for the Forex performance in January, I remember that all of these major currencies had gained against the dollar. However, besides this happening, in February, there has been a big change where now a majority of them are now on the losing side to the dollar. So Japanese yen leading here, losing further to the dollar as the Bank of Japan chose to maintain interest rates at negative 0.1%. The yield curve control at plus or minus 0.5%. And also they chose to continue quantitative easing despite having high inflation. So this led to much weaker Japanese yen, and we could trade towards the next week while shorting the yen and looking for a strong pair to pair with it. So New Zealand dollar also down 1.2%, UK pound down 0.63%, euro down 0.10%. This is since the beginning of the year. Swiss franc also down. And now the only currencies that are positively forming against the dollar year to date are Australian dollar and the Canadian dollar. So from the data that we saw in Australia, it's indicating that the RBA will get more aggressive with rate hikes, and the Canadian economy is getting to achieve its target of slower inflation. So in this case, they have a much more stable currency. So those are the key highlights for today, and I hope it made a lot of sense to you guys. So for the daily, that is performance today, you can see the Canadian dollar has been the weakest, whereas the Japanese yen has been the strongest. However, this is historical information, so we are much more interested with the performance for a bigger period of time. So if you look at the month to date, since the 1st of February, the current price level, then the dollar has been stronger than all these other currencies. So since the beginning of February, the dollar has been very strong, gaining against these other currencies, with the biggest gain happening in JPY, New Zealand, followed by the pound, Australian dollar, euro, Canadian dollar, and the Swiss franc. So that's it for today, and I hope I've answered all of your questions. Just checking on the last questions before we end the session. So why is this market appearing not to trust the Fed? Is this the first time there is an adage that goes that don't fight the Fed? The market doesn't appear to give credibility to the Fed. So yes, this is quite normal. It's nothing new in the markets. So we normally say that don't fight the Fed. You always follow the direction that the Fed is saying. So the Fed is basically saying that it's looking to slow down interest rate hikes if the economy responds in kind. However, from the data we are seeing in the market, it's indicating a strong economy, and now the Fed has not yet decided to go for a stronger rate hike. So investors are taking this period of indecision to make the bull run. So the bull run is short term. Everyone knows it's not going to last for long. So this is not the bottom of the bear market. We'll only see a bottom when the Fed decides to pivot and start cutting interest rates. So far, Jerome Powell has already identified that and said that this year we will not be seeing any rate cuts. So with that off the books, then we are looking at rate hikes. And as long as there is quantitative tightening happening in the US, then the bear market continues. So whereas a lot of investors are enjoying the bull run, it's basically what you call a momo trade or a momentum trade. Everyone wants to take some quick profit from their current rally, but eventually the rally will weaken and the market will resume its trend that we have had since last year. So Fed hopes are suffering in for 50 basis points. Here the market is unmoved. Yes, eventually the market will react. So just be patient. So remember, trading is not about being right. It's more or less about being patient and making the right entries and exits. So just hold your cards tight. Watch for weaknesses in these bull runs. And once you identify the opportunities, then you definitely go for them. So thank you very much, guys. Thank you for your time and participation. Also, I appreciate your commentary. Your interaction in this space is very, very important. And I hope to see you guys on the next session. So remember, we don't have a session on Friday. So enjoy the rest of your weekend. Hope to see you on Monday at 11 a.m. when we cover the market snapshot. So the market snapshot series is very simple. We do these at 11 a.m., cover the highlights for the day, news expected, key price levels expected. This is very short term, between 10 and 15 minutes. So every Monday to Thursday, 11 a.m., sure to join, and hopefully we get to create value and grow together.